All right, we're going to go ahead and kick it off and get started. I do want to say welcome to everyone. For Thanks for attending. Thanks for signing up for this webinar. We're excited to present tonight a great topic that I get asked a lot of questions about, and my favorite response is you need to consult your real estate, your CPA, your accountant, your tax advisor. Well, we've got CPA here on the line today, so we're really excited to talk about the tax benefits for passive investors. So welcome everyone. We're going to jump right in and go ahead and get started. A couple of housekeeping rules. There is a Q&A box at the bottom of your screen, whether you're on your phone or you're on your desktop, your iPad. There's a Q&A button, a couple of bubbles you'll see next to each other. Drop your questions in the Q&A box. We want to answer as many questions as we possibly can. We're here to help add value to you and provide educational resources. So don't be afraid to ask a question. There's no such thing as a silly question. We'll get those answered at the end, any Q&As at the end. If you want these slides that Bill is going to present here, just shoot us a text 281-559-7061. I'll make sure I shoot these slides over to you at the very end. And just a quick disclaimer, this webinar is for educational purpose and should not be considered as legal, accounting, or investment advice. The information on this webinar is not present an offer to sell or a solicitation of a security. And obviously, please consult with your own attorney, financial advisor, or CPA for any legal matters in regards to any investments, or if you have any specific tax questions. Again, we're going to try to answer as many questions as we can today. Throw them in the Q&A box. But of course, if you have specific questions, I would advise you to consult your personal advisors, whether that be an attorney or CPA that you work with, or to reach out to Bill. He can provide his contact information at the end. He's a great resource of knowledge as well. A little bit about us. If it's your first time here on the webinar, I want to say welcome again. Thanks for joining us. My name is Brian. I'm the Director of Investor Relations here at Headway Capital. But just to tell you a little bit about our firm, and won't go too long, we were designed to build and protect the wealth of busy professionals. We started Headway Properties and Headway Capital in 2018, and our goal is to provide investment opportunities that give high net worth accredited investors the freedom to do what matters most to them and not to focus on generating returns through real estate. We do the hard work for them. So we have extensive experience sourcing, vetting, and investing in alternative assets through multiple market cycles. So our bread and butter is multifamily real estate, commercial real estate, value add multifamily real estate. And that's what we've been doing now for 6+ years. Sid Shamim is our CEO and founder. He started Headway, as I mentioned, late 17, early 18. Before that, he was investing as a passive investor, like several of you are. Had a pretty sizable passive investing portfolio. And him and his wife, Anam, actually also had about 33 or 34 rent houses as well. So they had a pretty sizable single family portfolio before they transitioned over to multifamily. Started Headway Properties and Headway Capital. We do self-manage our own assets that are here in the Houston, Texas market. As I mentioned, I'm the Director of Investor Relations. My name's Brian Alfaro. My job is to provide all of our investors with that white glove service and make sure that I am communicating with you on upcoming and existing investment opportunities, making sure I get any questions answered you might have about particular offerings. And then, of course, once an investment is placed, making sure you're taken care of along the journey. And then last but not least, Mr. Umar Naqvi, he is our CFO and CIO. He's a numbers guy that makes sure that all of our finances are in order and that our company is healthy and profitable, and all of our assets that we buy are healthy and profitable as well. A little bit about our track record before we hand it over to Bill. A little over 500 million in assets under management, which equates to a little over 3,000 units. We target a 25 to 30% average annualized return. So we like to double our investors' money in 3 to 5 years. That's really our goal. And we do have over 400 active investing partners today. How we produce results, sort of our secret sauce, as we like to call it. We're really focused on what we do. We focus on value add multifamily. We also have a couple other assets that we have open from time to time, but really our bread and butter is at multifamily. We're purposeful and disciplined in all the actions that we take. So we try to make sure that everything that we do at Headway aligns with our thesis and our core values. And we stay disciplined as well. We try not to get shiny object syndrome and stay in our lane. And really, our goal is to be consistent, right? So we always want to be consistent with our performance. We want to be consistent in our communication. And we want to make sure that we are being consistent for our investors. We're going to jump right in if Mr. Bill is ready. So I want to welcome to the stage here Mr. Bill Pilkington. If you have not met Bill, I will say that Bill is not your average CPA. And the reason I'll say that is because Bill, you're probably the most outgoing CPA I've ever met. My wife is an accountant by trade. She's not a CPA, but she's an accountant, and she says she loves her spreadsheets because they don't talk back. So Bill loves to talk. He's a social butterfly, as I like to say, and he's a wealth of knowledge when it comes to particularly real estate investing. So if you're a passive investor or you're an active investor in any capacity in real estate, if you haven't talked to Bill, you're doing yourself a disservice. If you're working with a CPA who doesn't know a lot about real estate, you're doing yourself a disservice. Bill is the man you want to talk to. So, Bill, without further ado, I'm going to hand it over to you. I'm going to allow you to share your screen and we'll start the presentation.
All right. Hey, thanks, Brian. Appreciate it. Hey, nice to meet y'all. So I'm Bill Pilkington. What we're going to be doing today, we're going to be kind of like just talking about, see that screen come through okay?
Not seeing it yet, Bill.
Let's see here. Hold on. Back here.
Yep, now we see it.
Okay. So, yeah, like Brian said, it's like what I choose to do, I choose to focus mostly on the real estate. It's been pretty good, me myself being a passive investor as well. Realized after doing single family and a couple of times, like, here in Texas, we keep the water heaters in the attic. And after the first one blew out, realized I don't really want to be doing single family anymore myself. That being said, it's an awesome investment for other people to do, just wasn't for me. So I chose to go the passive route. In addition to that, I like helping people, as they go through, because sometimes it gets kind of scary for them. Like, hey, what do I do? What does this all mean with the real estate? So, what we're going to go through this evening is kind of talk about some of the advantages of being a passive investor. We will dip into a little bit of real estate professional versus passive. And then inside of being a passive, some people use their IRA money, which is an awesome way to invest, and other people choose to do with after tax money. We also call that non qualified. We're going to talk a little bit about both of those as well. You can put your questions in there in the chat box as we go along. I'll stay as long as Brian will let me to keep answering any questions you have, that may be more specific to you. And so with that, so you can always email me. There's my email on the screen, but the best way to get a hold of me is to call the number up there, and that'll ring Tyler. Tyler in my office handles all of my meetings, and so he does all of the scheduling. And you can email me. I'll probably just forward it over to him. And so anybody here on the meeting tonight, if you want to have a call, usually we do like a 30-minute Zoom call and just kind of go over maybe your personal situation. You're here with Headway Capital. There's no charge for you if we talk. And FYI, I won't have a contract for you to sign either. So it's not like, I'll only talk to you or sign now. Here's the deal. We kind of talk about, how we work, how we operate. And if it works good for you, makes sense, we can move forward. And if not, I promise you, I'm not any type of stalker. I'm just kind of here to help out. Brian and Sid, they've been great to me. And so kind of like just kind of give back. So everybody kind of knows nothing, heard before, nothing in this world certain but death and taxes. Main difference being Congress doesn't meet every year to decide, when and where your death is going to happen. Taking care of the taxes is one of the things we do. Our job, while I say we sell tax returns, we're here to kind of give you peace of mind. And so tonight, hopefully, we'll kind of give you a little bit better insight as to how the taxes work when you're invested in real estate, because it is something different than just your traditional investments. The way that the IRS treats it is going to be slightly different as well. Lots of great advantages. And when you do it the right way, you can often, like we say, like defer, 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 die. There's ways to keep pushing the taxes off for the future, but do it wrong, it could come back to haunt you pretty fast. So what we often talk about is like, look, real estate, I like to look at as a passive investor, at least for myself, it's a second stream of money. And if, just like Warren Buffett says, if you don't find a way to make money while you sleep, you'll work until you die. Finding a second stream of money, getting your money to work for you, that's generally speaking, in terms of real estate, cash flow, getting the cash flow to work for you, to keep working for you. One of the best books that I've read on it is the one, The Richest Man in Babylon. Kind of helps teach a lot of these principles of what you're doing. That one, Rich Dad, Poor Dad, all kinds of good things. There's no way we're going to cover everything tonight. Things that, Brian will be help teaching you, that'll help you learn, but it's one of those, that's why we end up going into the real estate. Okay, I'm sure a lot of you are probably looking at this like, what in the world would people working out have to do with real estate? And what it really has to do is more of like diversifying. So people often ask me, like, hey, should I put all my money in this investment? Do which investment? I recommend you get into a couple of passive deals because one, it's a lot like going to the gym. If you work out and do your arms and all you ever work out on your arms, you're going to have really good arms, but you might have little chicken legs. And if you're only working out on your legs, well, that's great, but you may have, just a little pigeon chest. So the best thing to do is a little bit of everything. Spread some of your stuff around. There's many different, ways to invest in the real estate. I would kind of look at getting a couple of different ones because sometimes one's going to pay off more than the other. Sometimes one may have a little cash flow than the other. But even more so, it comes to when they sell. Because one of the biggest advantages of having multiple portfolios is the ability to defer the tax. Because with real estate, you're often getting a lot of your deductions up front. So you get your deductions up front, and then until you recover all of your expenses, all of the depreciation, all of the tax losses that you may have taken, you're not paying any tax. So if you're invested in one deal, well, first off, I say you got to get into your first deal or else you're just going to be, I'm a gunner. But when you get into one deal, that is great, except when that one deal sells, if you don't get into another one, you might be paying a big tax bill on that sale. Now, granted, taxes are still less than 100%. So you're going to end up with more than you started with. But most of my clients are like, well, what if I don't want to pay the tax? That's when having multiple investments, much like having multiple beakers with the water, because you can borrow from one to fill up the other. So, like, say, for example, you are in 5 different passive deals, and each one of those deals is carrying a loss of $20,000. That's a tax loss. It doesn't mean you really lost cash. It just means for tax purposes, we've been able to take some extra deductions. So collectively, we have $100,000. Now, these losses are all held behind glass, and that glass says break in case of profits. And so say we sell one deal and it has a gain of 60,000. So 60,000. Well, from that deal alone, we were able to use 20,000 of losses to offset the tax impact. But it still leaves you with 40,000 of gain. So what we do is we just take 10,000 from each of the other deals and we pay no tax. 60,000 gain, we pay no tax. Now, granted, we did it because we used the losses from the other deals. Once we use those losses, we can't use them again. But for time value of money, you've now got this gain that you can redeploy the capital into deal number 6. And guess what happens? It's going to create new tax losses. So you're going to continue to receive the cash flow without having to pay the additional taxes in that year. Now, not paying it in that year and tax-free are not the same thing. We're talking about a tax-deferred strategy, which does go back to the death and taxes. It is possible to get out of all the tax by dying, but what we're really wanting to do is just kind of defer when those taxes are due, giving us the time value of money, giving us the cash flow now, and worrying about the taxes later. Now, most deals that you invest in are through an LLC. That stands for Limited Liability company. What that means is you are going to be taxed as a partner. Now, you're not a true partner because a partner sometimes carries extra liability. You're going to be called a member of the LLC. That LLC is going to be the entity that owns the real estate. And so the LLC will hold the title to the real estate, and what you hold is title to the LLC. What that means in terms of tax purposes is that LLCs, they don't pay tax. They have a profit, they have a loss. The LLC is not paying the tax. You as individuals will ultimately pay any tax. So much like a spaghetti colander, hot water, cold water, either way, the water goes in and runs out the sides. Your ownership percentage determines how big that hole is. So there's potentially 100 holes, each one having 1%, just kind of making up numbers. If you own 2, 3, 4, 5%, maybe 2, 3, 4, 5 of those holes are pointing the water out towards you. The LLC's job is to say, hey, as an LLC this year, we had 100,000 of profits. Therefore, we are going to allocate 100,000 of income to you. And so that 100,000 of income gets reported on your tax return. If they have 100,000 of losses, that 100,000 of losses passes out to you for you to put on your tax return. Now, income and losses are not the same thing as cash flow. With respect to the IRS, they just call your cash flow a return of your capital. Even though we're investing money, we're getting a cash on cash return. I'm just talking IRS rules. And so that's how you're able to start getting paid your cash flow, but not paying taxes. Because also at the same time, your losses come first. We're going to front load your losses. And then as we have income, we're really drawing down from your bank of losses, not paying taxes today because you're just recovering some of your initial investment. Now, the way that your investment gets reported to you is on what's called a K1. Many of you have probably already received these. Some of you, this might be the first year you receive them. What you're going to receive is the K1. It's going to give you the name of the LLC you invested. It's going to give your name, or if you invested through your IRA, it'll have the name of your custodian. And then it's going to give you some other information, like here's in box 2, the top towards the middle. So that's going to give you things like, okay, how much was the rental income or loss that we have to report? Over in box 19 is going to be how much cash you received. And then in the capital account, box L, that's going to say, basically it's going to show how much you've put in. It's a cumulative, then, what was the income or minus what was the loss, minus how much you've had distributed out to you already. This is important because when you're planning for taxes, how much ever cash you receive upon the final sale, if you look at your ending capital account, compare that to how much cash you receive. That's basically if you receive more than your capital, short version is that's how much your gain is going to be. That's what your income is going to be. Just don't forget, if you have other deals, we may be sheltering that gain based on the losses from the other deals. Typically, the K1s come out in March of each year. So like we usually try to get all of them out on or before March 15. So you should be expecting your K1s around March 15, maybe a little bit earlier. You will use these K1s to prepare your personal taxes, which are then due by April 15. And so if you haven't got one now, that's fine. It's okay. If you are going past March 15, that's when you start having to ask, hey, where's my K1? When do we expect to receive it? I wouldn't bother the leads before then because usually the promise is we'll have it out by March 15. Now, the K1 I showed gives basically the income or loss for the federal, which is another way of saying the IRS return. Here in Texas, we kind of tend to think that, we're the only things really in the country, or at least away, far and away the biggest, which being in Texas has a lot of benefits for taxes. Number one, we don't have a state income tax. So the income that you earn, there will be tax potentially at the IRS level, but Texas is not going after you as an individual. That's not necessarily true in all the other states. Some of the states will have investments in things in that state that are not subject to the state income tax. But then a lot of the other states, on top of the IRS, you might have to worry about taxes for that state, which is also another way of saying you may have to file in another state. So as we look across the US, there's really 51 different opportunities, 50 states plus Washington, D.C. Washington, D.C. actually has its own separate tax codes of things that have to get filed there. So do not be afraid of investing in another state, because there's actually sometimes very good returns you can make in the other state. You just want to be conscious that if you invest in one of the other states, you might have to file an income tax for that state. Now, going back to my example of the 5 properties and offsetting the losses, that was true at the federal, the IRS level. Now, if we zoom into the state, it's still the same principle. And if all 5 investments are in the same state, that's fine. You can lose those losses to offset it. But if, say, you only had 2 properties in that state and they're each carrying the 20,000 loss and one sells for the 60,000 gain, you're only going to be able to use the losses from those 2 properties. So you would only be able to offset 40,000 of the gain into that state. Zoom out to the IRS level, you sold one, you still got all the other K1s, all your other passive investments to offset it. So again, it's just kind of one of those, make sure as you're investing into different states, understand what you're getting into. Now, I've been talking a little bit about how income and loss is not the same thing as cash flow. And the reason for that, accounting is really kind of a mix of art and science. And so a normal logical person, i.e., someone who's not a CPA, they'd be real easy to understand cash flow. Hey, I put this much money in. How much is coming out to me? If it's coming out to me, that must be income. If it's not coming out to me, I don't have any income. Not exactly the same thing when it comes to investing in the real estate, because of things like mortgage payments. Sometimes the payments are not the deduction. The interest on the payment, or if there's any property taxes, or the payment, but not the actual principal. The way we recover the principal is through something called depreciation. Now, depreciation is another way of saying, how do I recover the cost of what we paid for? Now, if it's land, we don't get to recover the cost of the land. But when there's a building involved, we get to deduct the cost of the building. Now, the deduction is based on various factors. One of them, or the main one, being, what did you actually buy? So if you say, I bought an apartment complex, and that's all you call it, that's going to be like one asset. It's going to divide out over 27 and a half years. So like one giant log on the fire, it's going to burn slow. It could take 27 and a half years to burn at a nice, even, smooth pace for 27 and a half years. Say, for example, it's 2.75 million was the purchase price. Well, actually, if you finance it or you pay cash for it, you're getting the same $100,000 deduction every year for depreciation. That's because the IRS says you can recover the cost of the investment through depreciation over time. A way we get around that is through cost segregation. cost segregation is a way of saying, well, how could I break this up into smaller pieces? Much like saying, I could have a hamburger, or I could have two all beef patties, special sauce, pickles, cheese, lettuce on a sesame seed bun. We're going to break it down into components. We're going to say, I didn't buy just an apartment complex. I bought a foundation. I bought a parking lot. I bought trees. I bought wiring. I bought air conditioning units. I bought boilers. I bought a roof. I bought carpet. I bought appliances. And so we start breaking these things down into smaller pieces. Well, as everyone knows, if you break that log into smaller pieces, it's going to burn a lot faster. Those smaller pieces will burn a lot faster, which is just like saying for the depreciation, instead of taking 27 and a half years, a good portion of that deduction might all be deducted in the first year. And so therefore accelerating the depreciation. At the end of the day, it's still the same log. We didn't create a new log. If we chop it up, we haven't gained or lost anything. We just put it into smaller pieces that when they burn a lot faster. That's all a cost segregation is. It's taking the exact same apartment, breaking it down into smaller pieces so that we can accelerate those deductions. But much like, things are burning faster, if we had a way to capture the heat and save it for later, if you have these losses that you're not able to deduct in the first year, because not all passive investors are able to deduct their losses in the first year, we save them for later. The reason I say that is because as a passive investor, the IRS, those losses, when I said they were trapped behind glass, the IRS is not going to let you take deductions in the current year for losses on passive investments. They will allow you to save those losses, but you don't deduct them in the current year. Now, that's on the non-cash investments. Some people decide to invest with an IRA. An excellent opportunity for your IRA. It just comes with one little catch. The IRS will say that if you are investing with an IRA, now they want to say, okay, are you actively managing the property? I.e., oftentimes people that invest into single families and they become their own property manager. If you were the lead investor on a multifamily, if you are using your IRA money for that, the IRS is going to tax you at 40%. I know it's an IRA. People think they don't have to pay tax on their IRA. If you have a Roth IRA, I understand this too. But if you are using it for a property that you are actively managing yourself, then your taxes could be as high as 40%. If you use your IRA to invest in a passive investment, it's not the passive investment that will cause you to owe tax. It's the fact that if that investment carries a mortgage, because if the underlying investment carries a mortgage, the IRS is saying, well, IRAs that invest in all cash deals, there's no tax. But IRAs that invest with a mortgage, well, now they're really making money off of borrowed money. And the IRS doesn't necessarily like borrowed money. So on the profits from the borrowed money, i.e., the mortgage, they're going to hit you with a tax of 20%. Now, the tax is called UBIT, unrelated business income tax. And I guarantee if you go try to do a Google search for IRA UBIT, it'll probably tell you there's no tax on passive investments. And that is 100% correct on the cash portion. Need to look one step further into what's called UDFI, unrelated debt financed income. And so when there is income and the threshold is $1,000, so if your income is below 1,000, it doesn't matter. But if you're using your IRA and it earns more than $1,000 of income, then that IRA needs to file a tax return. That tax return is going to be called a Form 990-T Tango. And the tax rate, now I say it's 20%. The real answer is the maximum long-term capital gains rate. It just so happens this year that number is 20%. If they change the rate up or down, then the rate you're going to pay of tax will go up or down. So it's the maximum long-term capital gains rate. Now, something new this year, 2023, if you're investing with your IRA, that IRA needs to obtain an employer identification number. That's the number you'll use. It's kind of like your Social Security number, but it's not your personal Social Security number. It's also not the tax ID number of your custodian. So it's not the number for Quest or Equity Trust, Fidelity, Vanguard. It's going to be unique to your IRA. If your IRA is invested in multiple deals, you use the same ID number. Your IRA could be invested with multiple custodians. It's going to be the same tax ID number. It's not the job of your custodian to obtain this number. It's not the job of the lead investor. It's you as the IRA owner have the burden of going and obtaining this tax ID number. It's not that hard. You can go to the IRS website. You can do a Google search for SS, like September 4, the number 4. So September number 4 online. If you do Google, probably the first 3 or 4 are some other type of site where they're going to charge you money for it. Scroll down until you see the one that says apply for EIN online, and it's www.irs.gov. So the IRS website. You'll go on there. It's going to ask you, like, why are you applying? You know, what type of entity? Are you a corporation, sole proprietor, LLC? You go down to the bottom and you'll select the one that says other reason. Click next, continue next. And then you're going to click the little box that says IRA. And then you'll click next. And then it's going to say you're going to file the form 990-T. You're going to fill in your personal information, your name, your social security number, and click the box, IRA. This is my IRA. At the end, it will give you, it's a little wizard that'll walk you through it. At the end, it'll ask you, do you want to obtain your ID number online or have them mail it to you? You want to click online, because what that does is the next time you click next, it's going to give you a PDF of your ID number, of your SS4. Save that PDF, maybe even print it out on a piece of paper. You want to save that because you need to give that to the lead investor of any investment you're using for your IRAs. And that's because that's new this year. 2023 is the first year the IRS is now requiring that as a disclosure on the K1. If y'all remember the K1 form back earlier, that's the one that lists the name of the partnership, your name, how much your gain or loss is going to be, how much your distributions were. In box 20, we have to disclose the tax ID number of your self-directed IRA. Now, there's another alternative. There's a self-directed 401k. Self-directed 401ks, they're still subject to the same 40% tax if you're managing your own property. But if you use a self-directed 401k to invest in a passive deal, there's no UBIT tax. There's no UDFI. It's specifically exempted. Now, that sounds great. And some people think, well, I just need to form a 401k, then not an IRA, right? You have to have a valid business reason to have that 401k, i.e., you need to be self-employed or own your own business, or maybe you're a member of another company that has a 401k that allows you to self-direct your investments. You can't form a solo 401k or a self-directed 401k just because you want to. I get it. People don't want to pay the 20% tax, but unless you have a valid business reason, the IRS is probably going to audit you and you're going to lose 10 out of 10 times. So only look at it if you truly have a business. And I don't mean newspapers where you're making, $20 a year. It has to be something very valid where you actually have a business with the ability to defer income. Because that's the other thing. Even if you have the business, you don't want to just do it one time. You want to grease the skids, defer money into it every year, put money away. which would be really nice because if you use the Roth 401k portion, all of your earnings eventually are 100% tax free. Another way people think, well, how do I get things tax free? Not in the IRA. We talk about defer, 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 die. All of these tax deferrals, if you are owned in a community property state and you're owning them either individually or jointly, basically as long as you're married, the surviving spouse is going to inherit everything tax free as long as it's not inside the IRA and it hasn't been gifted to any type of trust. Typically, what we try to do is defer the taxes. And the nice part is that, at least in community property states like Texas, the surviving spouse does not inherit any type of tax liability. If you're single, or say both spouses die together and kids inherit it or somebody else inherits it, well, currently per person it's the first 12.5 million, so could be up to 25 million worth of assets are passing on tax free. Those people want to remember, and what they're going to want to do is get a valuation of the partnership, because the IRS will allow them to basically do a reset. Keep on your own books. It's what's called outside basis, meaning the partnership is not going to do the calculations for you. They can give you the value of the asset. You on the outside have to reset everything so you can recalculate any type of gain or loss when you sell. Now, hopefully this never happens to anybody, but truth is, 1 out of every 1 people die. I used to be a fireman, so sometimes it's the innocent person driving through the green light that gets hit by the drunk driver. Something to consider. Something you want to make sure also that you've got your wills updated. Who do you have listed as your beneficiary? And just kind of keeping everything legal. Again, talk to your own attorney, talk to your own CPA. We're here to help, but I'm not exclusive. If you've got a good attorney, a good CPA, use them. I mean, if they're good to you, they're treating you right, they communicate well with you, use them. I mean, that's, what you should do is make sure you have a good communication level with them. Now, one of the big things with the real estate investing, we kind of talked a little bit about the losses held behind glass. And as a passive investor, typically what's happening is you're getting the losses up front, held behind glass or in a bank, which means we will use those to offset future income. The best way to think about this as a passive investor, the goal is to increase your cash flow without increasing your taxes. So if they can increase the money that's going into your checkbook, but your tax bill stays flat, meaning it's the same thing whether you had the real estate or not, that's typically the goal of a passive investor. Not the same thing for a real estate professional with active participation. Real estate professionals with active participation are able to deduct those losses today. And in the case of a married couple, if one is a real estate professional, the benefit extends to both. And so therefore, losses from these passive investments become deductible on the tax return, offsetting the W-2 income or offsetting any IRA distributions, offsetting any 401k distributions. We're able to deduct those losses against the ordinary income, but that's only when the person qualifies. So if they don't qualify, the benefits aren't lost. They're just used in future years. So what does that mean to be a real estate professional? Well, it means you have to spend at least 750 hours per year working in what they call a real property trade or business. So working something in the real estate area. Does not include mortgage brokers, does not include lending money. It has to be something else, touching with the property. Now, 750 is the minimum threshold. What you also have to do is have one more hour than half of all the time you work. So it's okay if you have a second job and you might work 500 hours a year at that second job, you still need 750 in the real estate. If you have another job that you work 800 hours in, you then need to work 801 in the real estate. If you work 1,000 hours in the other job, you need to work 1,001. kind of where I'm going with this. People with a full-time job typically work 2,000 hours a year. They often want to try to qualify as a real estate professional. That means they have to work 2,001 hours in real estate. That means they're working 4,000 hours, 4,001 hours per year, working 80 hours per week. So physically, that is actually possible. It's not impossible. Not likely, but impossible. I love Jose Altuve, great baseball player. Theoretically, he could bat 750. Probably not going to happen. Jordan Alvarez could, in theory, hit a home run 150 times. Probably not going to happen, but is possible. So it's one of those, the IRS will look at what's the more likely scenario. And in the event they want proof, they're going to want to see timesheets. How do you prove your hours? How are you proving the 750 hours? The other thing is, if you work for somebody else in the real estate industry, like imagine you work for a construction company, you work for a real estate brokerage company, you work for a property management company, you work for somebody that's a landlord. Unless you own more than 5% of the company, your hours are not going to count. So you have to have an ownership stake in the company as well as working those hours. And again, the way they come down to it being your primary occupation, they look at all the hours you worked, and one more hour than half has to be in the real estate. Now, if the only thing you do is real estate and you spend 800 hours a year, well, 100% of them are real estate, so you're going to qualify. Things that kind of qualify as real in the real property trader business. If you're in the business of renting or leasing, you could be a property manager, construction, reconstruction, remodel, redevelopment. You could be doing someone's acquisitions. You could be like the broker buying or selling. You could be in property management. Loans, borrowing money, lending money does not qualify. I don't know. I guess they didn't have as good of a lobby because if you're a real estate lawyer or you're a real estate CPA, those hours do qualify, but not being a loan broker. Being an appraiser, that qualifies. Now, that all qualifies you to be a real estate professional. That is just one of the tests. You might have caught it when I said it before, but if not, in order to take the deductions, you have to be not only a real estate professional, you also have to have what they call active participation. Active participation is another way of saying doing the things landlords do, doing the things that those that sign the front of the checks do, not the back. So investing passively, unless you're the lead investor, those hours don't count. All the time coming to study and listening to presentations do not count. You have to actively be involved in the management of the company, i.e., being the property landlord. Now, of those 750 hours, 500 could be in the management. You don't necessarily have to have 1,250. But if you were, say, a real estate broker or a real estate agent spending 1,000 hours buying and selling properties, that's 0 hours as a landlord. You're still going to need to have 500 hours as a landlord. The nice thing is, though, while the one person needs the 750 to be considered their primary occupation, if you're married, the 500 can be split between the two. It can even be 0 on one and 500 on the other. So if you need 750 to be the real estate professional, but say the real estate professional could be a landlord, but could be, say, a real estate agent spending 1,000 hours a year, but they don't spend any time managing the property, but their spouse spends 500 hours a year. Now they're going to qualify because the spouse picked up the 500 hours. And that spouse could have another job working 1,000 hours somewhere else. They don't have to meet all the thresholds for the real estate professional. Only one needs to meet the threshold for the real estate professional. And then jointly, they have to have the 500 hours. So again, it's 750 hours as an individual, 500 hours as a couple. It's possible one person, if you spend 1,000 hours a year managing your own properties, you're in. You don't have to get more. If you spend 800 hours a year and that's all you do, you don't have another job, you're in, you qualify, whether you're single or married. So it's just different ways to qualify. And again, that's if you want to qualify to take the loss deductions on your current tax return. That's what it means to be, you always hear an REP or a real estate professional. Hey, there's all these deductions, which are great. And if you want to deduct them on your current tax return, you have to meet that requirement. If you don't, you become a passive investor. You still get to take advantage of all of those losses, just not today. They get spread out into the future to offset future income. So, last thing, it's February 15th. K1s will probably be coming out in about a month. You really need to start getting your records together, because if you want to prepare your own return or if you're having a CPA prepare them, a lot of times, because if you're giving them to your CPA, just FYI, it's like a factory assembly line. You're going to get put in line. We're already having people, we're extending people like, hey, April 15th stuff, we can probably get your extension in. It's a case I'm hearing across the country with other CPAs. One of those, if you're looking to act, I recommend you start checking with your CPA now. You can do it yourself. It's not like you have to use a CPA, but if you're unsure or you need help, you want to get a good CPA that knows what they're doing. Actually, a good tax professional. They could be an enrolled agent. There's great tax professionals. They don't have to be a CPA, but you want to make sure they understand the real estate. They want to understand, what are your other expenses? What are you doing? How do you qualify? You want to make sure they understand the difference between a passive and a real estate professional. But the real thing is you want to get in early. And so you're in queue to get your returns done. Extensions are fine. IRS allows you to extend your time to file, but they just want their money. April 15th, they want their money. They'll let you another 6 months to get the paperwork in. They just want their money by April 15th. But anyway, we can kind of go now, see if y'all have questions, whatever we can do to kind of help answer you. And again, here's Tyler. Best way to get a hold of me, email Tyler Benavides. So T Benavides at sethandalexander.com. Same phone number, 713-965-7572. And he's at extension 728. Just tell him, hey, I saw you on the Headway show. Can I get on Bill's calendar for 20, 30 minutes? Just kind of talk to him about the stuff. Talk to you. No obligation. Just here to help, give some answers. But if you've got a burning question, we can answer them right now.
Yeah,
And
Bill,
with that, I'll turn back to Brian.
yeah, awesome job, Bill. I love how simple you make something so complicated. I'm not a tax guy, obviously. That's why I pay you to do my taxes and why we pay you to do our taxes. But you break down things that are often, I would say, very complicated, or maybe sometimes when I talk to previous CPAs, and I feel like sometimes they intentionally try to make it confusing, just because I guess it makes you feel like you should pay more money. But you do a great job of breaking things down and making it simple. So I appreciate that. And we do have some questions coming in. So we'll stay here and hang around for a few minutes and get these questions in. If you have a question, please put it in the Q&A box. I've got some here, and then I see Johnny has a question. So Johnny, if you're open to speaking, I'll allow you to talk and bring you on stage. There you are, Johnny. So if you want to unmute yourself, feel free to ask your question. Or maybe he accidentally raised his hand. I do have a question here, Bill, that I see from David. Bill, do you know a way to write off an IRA distribution with a passive investment, or do you have to be active to offset the withdrawal?
So they are going to be separate transactions. The IRA distribution will create taxable income. And so I even know that you might use that income to buy the real estate that has a loss. But the IRS does not allow you to use the real estate losses to offset the income as a passive. It's actually almost the same thing as like your W-2 income. You're picking up W-2 income, your job. It's creating cash to buy into these investments. But if you're a passive, you cannot use those losses to offset your W-2. The only way you get there is to be a real estate professional with the active participation. And even real estate professionals with active participation that might get these large losses, if they're cashing out of their IRA early, there's a 10% penalty if they're under 59 and a half. You could have all the losses in the world. It is not going to avoid that 10% penalty. The only way you can really avoid that 10% penalty, there's certain exceptions when you take money out. One way that people don't know about is through what's called a QDRO, a QDRO, Qualified Domestic Relations Order. That's a way of getting money out of your 401k, 403b, 457. If you have a plan at work, you may be able to get some of that money out if you are married. And it's a lot like the Shawshank Redemption. If y'all remember when Andy Dufresne asked the guard, "Do you trust your wife?" Almost got him thrown off the roof. But if you trust your spouse, you give your entire retirement account to them. And if you give it to them, they have the ability to cash it out. You still have tax, but don't forget, you're always going to have tax on it. But because they cashed it out, not you, there's no 10% penalty. So it's lawyers take care of that. Usually it costs about $5,000 to do it. So I usually say, don't do it unless you're cashing out more than 50,000. Just let you know, there are ways to get it out there.
I appreciate that, Bill. Hopefully that answers your question. I got another one here. It says, for passives, can you deduct the membership fee for real estate education and mentoring groups? What tax form can you add that to? I guess if somebody has like a coaching, they're in on some sort of,
Yep.
lifestyle, some rock group, what can you do there?
So what's typically happening is you're paying these membership fees in order to get into some of these investments. So you're, as an investor, you're buying into a partnership. It's much like running a business. Now, this is for non-IRA investments, because if it's inside of an IRA, you might as well consider that a whole separate corporation. But if you're investing as an individual and that LLC you're investing in is saying, we're not reimbursing you for anything. If you spend money on your own, that's on your own. We have a policy where we do not reimburse for those. Then that becomes an unreimbursed partnership expense. So your deductions add to your losses. They're not going to offset your current income, but say the real estate investment you're in has a 15,000 loss and you paid $20,000 for a training class. Well, what that means is now you've got a $35,000 loss. The loss gets added. It goes first on the Schedule E, and then it carries over to the Form 8582, which, so all passives, you want to pay attention to your Form 8582, because that's going to tell you your cumulative losses. Another way of saying, how much do I have to show in income before I have to start paying tax?
Got it. Makes sense. Makes sense. Appreciate that, Bill. Johnny, I don't know if you still want to ask your question, but please just unmute yourself. I'll give you the mic if you'd like to ask your question. If not, we got another one on here from Gerard. It says, in your 5 LP investment scenario, I guess when you were talking about your waterfall, your buckets there, Bill, for active real estate professionals, do they have to be active in all 5 investments to take all losses in a given year?
No. So the way it works, real estate professionals are a pass fail. Once you qualify as the real estate professional with active participation, you've reached the threshold. So you can spend 1 minute a year in the other investments. That 500 hours is what allows you to take the deductions from those other passive investments. Now, the one thing, kind of a qualifier, is it's an all or none, because what you do is you have to attach a statement to your return where you aggregate all of your hours together and all of your investments together. So what's that saying is, in that scenario, like with the 5 investments, if independent of those 5, remember, if you're a limited partner in those 5, you get 0 credit for those. None of those hours count. You have to independently qualify for your 750 hours or your 500 hours. If you independent, and that's another way of saying, if you as a passive and the lead investor, you're talking together about the financials, that's great. The lead investor, they get to count the hours. The passive gets 0 credit because they can't make any decisions. They can't sign the check to hire the contractor. They can't do anything. They're just a passive. The lead investor is the one that has to take the risk. The lead investor is the one that has to sign the check. So If they independently qualify, they get to deduct all of those losses.
Makes sense. Makes sense. Little tricks of the trade. I have a question that somebody told me to ask you, and I'm curious. We didn't talk about this today, and there's kind of like some different things kind of bouncing around in the courts or the laws, so to speak. Can you talk a little bit about the bonus depreciation phase out and how that might impact investors today and going forward if they don't change the law and put it back at
Yep.
100%?
So if you remember my log on the fire example, that was talking about cost segregation, taking something and breaking it down. So like the apartment itself is 27 and a half years. You break it down, parking lot improvements, land improvements, those typically go for 15 years. Air conditioners, HVAC units, those are typically 7 years. And then sometimes like appliances or different things might be like a 5-year depreciation. That's not going away. The ability to deduct things instead of 27 years, take them out over 15 or 7 or 5. Now, in order to get that, you have to hire somebody to tell you what those are. That's not going away. What the law was, they said anything with a life of less than 20, it came out as you could take 100% depreciation in the first year. So they break the asset out. Again, say that 2.75 million asset, and they say 300,000 is a 5-year asset, 300,000 is a 7-year asset, $1 million is a 15-year asset. That's 1.6 million. They could write off 100% in the first year. The only way they were able to get that through Congress, they had to create a sunset. So starting then in 2022, it starts dropping. And so what happened was instead of 100%, it dropped to 80, and then it drops to 60, and then it'll drop to 40, and then it drops to 20. And so then the bonus depreciation, which is another way of saying writing it all off in the first year, that is phasing out. Now for 2023, so again, so that was just the 80% or 60%. And so you don't get the full amount. Congress might change the law. They have the ability to change the law. I don't know. It's Congress, but right now it's set to phase out. And so it is possible that heavy upfront year one depreciation may go away. But a cost segregation is still good because instead of waiting 27 years, now you're going to recover some stuff in 5 years, some stuff in 7, some stuff in 15. But unless Congress changes the law back and they bring it back.
I have a feeling, I could be wrong, that if the political party in charge flips over, that we could see it come back.
Yeah, I would say
But
that, but I'm not trying to get
yeah,
yes,
we'll see.
because
Again,
it was the
it doesn't matter
previous
what side.
political party that created that law,
Right,
not
right.
taking sides, just saying yes.
Exactly. I'm not what side you're on is completely irrelevant. We just know the side that prefers that is the other side, and I have a personal feeling that that could be one of the early things on the bill or the docket, so to speak, if they're able to, because it is an election year, right? And those things matter to the people and the lobbyists and the politicians in charge. So we are here at the top of the hour, Bill. We got several questions in. I just want to say thank you again for coming. I think you add a ton of value every time I speak to you. I feel like I learn something new. And you really do a great job of bringing things into perspective and keeping things very simple for people. I will make sure that everybody who is on this webinar gets Bill's info in the follow-up email. If you haven't talked to Bill, if you're not working with a CPA who understands real estate, I highly recommend you reach out to Bill. I interviewed too many CPAs before I ended up on Bill. I worked with one that wasn't that great before I worked with Bill, and there's just something unique about working with somebody who understands real estate. If you're investing in real estate and your CPA does not understand real estate, you're probably leaving some meat on the bone, and you might be paying too much taxes. So the least you can do is talk to Bill, get on a consulting call. He can add a lot of value to you. So thanks to everyone for attending tonight. Bill, thanks again for coming. If you want to reach out to me, you guys know how to get a hold of me. You can email me at brian@headwaycapital.us or visit our website. And we look forward to seeing everyone again here next week. Have a good evening.
Thanks. Y'all take care.